RBI Governor Shaktikanta on the back of the monetary policy decisions that have been taken in the past 3 days. The big headline, of course, is that the stance remains withdrawal of accommodation and the rates, the repo rates are unchanged, Kartik. That, of course, is the big takeaway from that monetary policy decisions. It is a very crucial, exciting time for the Indian economy, of course, because on the back of all the announcements made, I think Governor is firm on the growth path that India has ahead for itself. Yeah. And of course, there's no need for change just as yet, given the global pressures that global economies continue to face.
Absolutely. So I think, in addition to the India story, and let's just reiterate the India story that Shaktikanta Das, the RBI governor, mentioned. So we are looking at repo rate being unchanged at 6.5%. We are looking at headline inflation to average out at 5.4% for financial year 24, the financial year that we are in. We are looking at the call rate to be fixed at 6.75%. And in addition to that, there is likely to be a global improvement in growth. There is likely to be a global tapering of inflation going ahead. But global headwinds continue to command India's inflation. And at the same time, the volatility in food prices, which are linked to, at one end, the global crisis, at the other end, the monsoon, is something that the RBI governor is watchful of.
Absolutely. And let's quickly also get in Vivek Kumar, economist at QuantEco, joining us on the show. Vivek, thank you very much for taking time out. Good to have you on the show. What, according to you, were the big takeaways from this MPC?
Hi, good morning. Good to be back. So I guess it's completely along expected lines with respect to the decision on interest rate as well as the policy stance. It's not just a vote for status quo. I think it's also a vote for confidence in the economy, because you've heard him say that they're expecting 7% GDP growth. Not many countries in the world at this point in time are projecting that kind of a growth number. I think more importantly, 7% GDP growth is getting accompanied by a slight amount of disinflation from somewhere close to 5.3% in the current financial year to 4.5% in next financial year. So while growth is almost, you could argue, steady at 7% handle, inflation is moderating. So that's a vote of confidence. And he did not just stop at the growth inflation balance. He also pointed out some of the strengths in India's external sector, both on the current account, which is the trade side, as well as on the services side. And while also taking pains to highlight that financing of the current account deficit is not a concern for India as such. So it's a vote for confidence. And I think the key message is the preservation of macro financial stability, which the RBI has made every attempt in the last 12 months to preserve. And going forward, that will be the primary goal.
Okay. In addition to that, Shweta, I think what has also caught my attention has been this review of e-trading platforms, which Shaktikanta Das just mentioned. So what is this review going to entail is going to be something that we should be watchful of. Are we going to see the trading platforms like Zerodha, Grow, etc. face more strict action from the RBI like we've seen in the fintech space? I think that is something that is going to emerge going forward. In addition to that, I think what has been a positive this time around has been the fact that RBI governor has also said that the transparency in the key fact sheet, key fact statements that was asked for and hinted upon earlier, that is also likely to become strengthened now. So RBI governor wants to include all the processing fees, all the one-time fees, all the retail MSME loans to be included in the loans and advances. But overall, I think the interest rate should be inclusive of all the other fees that go into, what the end consumer actually pays to banks, to be included as part of the interest rate. I think these are important takeaways for the consumer at the end.
All right, absolutely. And since we are on important takeaways, let's go after them one by one. Vivek, firstly on the growth path, at 7.3%, RBI governor reinstating that is going to be the growth trajectory for India. But also talking about headline inflation, he hinted at how, a lot of things that are not in government's control, and one of them could be the adverse economic impact of what comes by the way of a weather condition in India. What are you making of inflation in the month of January? Because we don't have the numbers for January just as yet. We do know that the average inflation that RBI and the government is accounting for would be to the tune of 5.4% in this entire year.
Yes, that's for the year. For the quarter that we are in currently, the projections were revised lower. So in the December policy review, the Q4, which is Jan-March quarter CPI inflation, was at 5.2%. It got revised lower to 5%. So that gives you a sense that vis-a-vis what RBI expected 2 months back, inflationary pressures are somewhat lower as far as this current quarter is concerned. And your broader point of 4.5%, and along with the risks that he highlighted, I think it's important to keep in mind, while yes, the trajectory of inflation is comforting, you're coming down from 5.3, 5.4% to 4.5% next year. There are, ample amount of risks which could spoil the party. And that clearly shows the vigilance and the caution in his statement, as well as the overall MPC's statement, which I'm assuming would be up on the website any moment now. That even with a 4.5% inflation, which is quite comforting, the governor and the RBI, they are not ready to let their guard down yet, because precisely because there are enough risks on the horizon, and you want to sail past those risks comfortably.
So, Vivek, does it mean that the higher for longer narrative is going to continue in India even till perhaps the end of this year? Because there were expectations that in Q1 of the next financial year, we might see some sort of a tapering of interest rates. But if headline inflation is unlikely to come below the 4.5% mark for all of FY25, then can we expect a rate cut anytime in the next financial year at all?
So that's something which the market participants are trying to place the bets on. I'll deviate a little bit from the narrative of higher for longer, Kartik, and probably use the term steady for longer, because RBI has been steady since February of last year, both in terms
Right.
of interest rates as well as in terms of its monetary policy stance. Now, as far as when do they pivot from their steady stance, we believe that it's probably going to happen after a gap of 6 months. And
Okay.
our rate cut expectations is starting from the month of October. So October, December, and February, which is the second half of the financial year, we could possibly see a cumulative rate cut of up to 75 basis points. So basically 25 basis points rate cut each.
Okay.
Now, why we are saying that we need to wait for 6 more months, 6 to 7 more months? One, we'll have clarity on food prices. We'll have clarity on monsoon, some of these risks that RBI has highlighted in a very distinct manner. Two, we'll have the full-fledged budget by then. So in
Right.
June or max by July, you'll have the full-fledged budget. And three, the Red Sea disturbance and the trade costs that could potentially increase, which the governor also highlighted. We will also get some sense as to whether the things are persisting on the geopolitical front in that manner, and is it leading to any pass-through in terms of import price pressures. So next 6 months, I guess you'll have a lot of answers to some of these risks that the governor highlighted.
Okay.
And it makes sense to wait out, because you've done the hard work, as he himself said that it's all about the last mile connectivity now. So we've almost done 4/5 of the journey. This is the last uh,
Last
bit of the
mile of
journey where you
disinflation.
right, yeah, you need to make sure that you win, you come home with a winner's flag, rather than lose whatever amount of gains that you've gathered in the past 12 months.
I have two questions for you at this point, and I would like to begin with the public debt that RBI governor referred to. He, of course, was referring to the IMF report suggesting that public debt in many developed and developing economies could touch 100% of the GDP. IMF also flagged risks for India, where public debt, both center and states combined, is at 57% of the GDP. How concerned are you about the public debt that India has on its books right now?
So debt is something which is both a relative game as well as an absolute game. So when you're comparing India vis-a-vis, let's say, other countries, I guess it's the picture will not be absolutely concerning. So some of the developed countries, especially post-COVID, they've seen the debt levels balloon. In case of India also, the debt levels shot up post-COVID. But vis-a-vis the increase in debt levels, especially in case of developed countries, our debt levels are much more manageable than what we are seeing in case of developed countries. Having said so, I think in terms of emerging market peers, India still kind of stands out as one of those countries having a little bit of higher debt pressure. So it's all about whom are you comparing yourself with? Are you comparing yourself with developed economies? I guess there India stands out much more favorably. If you're comparing yourself with similar peers in the emerging market space, then I guess India probably is on the higher end of the debt spectrum. Now, is it concerning at an absolute level? Is the other question. Well, I guess India fortunately is blessed with a relatively higher profile of nominal GDP. And for that sustainability, nominal GDP growth is absolutely important because you need to ensure that the economy grows at 10%, 11%, the least, to be able to service that debt. So India, even if you're assuming a 6.5% steady state real GDP growth and add about 4.5% of inflation, CPI, WPI combined, you land up somewhere close to 11% GDP. So that doesn't really let the problem go out of hand. You will still be able to consolidate debt. It's just that the initial shock that we received post-COVID, it will take us a little bit of while to get back to pre-COVID levels.
All right. And of course, the other question is on rural demand. Governor also hinting at the fact that rural demand is picking up. There is a pickup in the affordable market segment. High frequency indicators are not quite likely in line with what the governor is saying at the moment. In your assessment, what are you making of the consumption picture in India in this quarter?
So in this quarter, very difficult to say because I guess from an economic standpoint, we tend to take a much more holistic view. Focus more on the next 4 quarters or maybe the annual view.
Let's then talk about the overall financial year. Do you see demand
yes,
pick up in rural economy? Because that remains a point of concern for a lot of economists and observers out there.
So the signals are mixed, I would say, at this point in time, because at one end you have still some of the scars from COVID playing out in case of the rural economy. You are also coming out from a very adverse, or maybe I would say not so very supportive monsoon backdrop. Last year we did not have a good monsoon in terms of its spread as well as its intensity. And yes, so meanwhile the scars of COVID continue to play. So that is one part of the drawback. The supporting side of the picture is that the government spending, especially in case of rural area, has been much more productive, both through targeted programs as well as the overall quantum of spending. So on one side you have these headwinds. On the other side, you have a little bit of cushion where the government is trying to preserve and provide. Now going forward, as far as the signals from interim budget is concerned. So the interim budget, we've got to keep in mind that it's interim. It has a very short shelf life, just about 3 to 4 months. But nevertheless, if we take that as a signal, then a couple of things we note. One is that the quantum of spending, especially directed towards rural, is normalizing. By normalizing, I mean that as a ratio to GDP, the rural spending is slowing down and getting back to its pre-COVID levels. The post-COVID, there was a shoot up in rural spending. Now it is getting scaled back. It's getting back to normal. So that is one. Number two is that the spending which is getting carried out currently is now being more chiseled and more focused. So you have more clarity on, let's say, something like a PM Awas Yojana, especially in case of Grameen. So they've got PM Awas Yojana Grameen, which has got higher allocation and which seems to be the focus area for the government. Now, housing is one sector, if I can add, has tremendous amount of forward and backward linkages, which is true in case of rural as well as urban parts. So if the government is trying to pick up housing as one sector where they are going to focus on tremendously, I think it should be able to provide a decent amount of support.
Right.
And besides this, I think there is also continued support from the LPG scheme. There is also continued support from the free food grain distribution program. So while the quantum of spending is normalizing, there is now much more directed spending at chosen sectors or maybe with respect to chosen themes as far as rural parts of the economy is concerned.
Okay.
So the overall guess would be that as we move forward, things should start improving on the rural front as well. And here again, the key assumption that we are making is that next year's monsoon is good because we are just coming out from a not so good monsoon scenario. Especially even in the current phase, the Rabi season, ongoing Rabi season, the monsoon hasn't been pretty adequate. So hopefully, if things turn out well on the weather front and with all these targeted measures from the government side, the rural part of the economy should also.
All right, Vivek Kumar, always a pleasure, sir. Thank you very much for taking time out and for speaking to us.
Thank you so much.